Financial statements. Financial statements are formal records of a company's financial activities and position. They provide an overview of the company's financial performance and its financial position at a specific point in time. The three main types of financial statements are the income statement, shows revenues, expenses, and profits; the balance sheet, displays assets, liabilities, and equity; and the cash flow statement, tracks cash inflows and outflows. Cash flows. Cash flows refer to the movement of money into and out of a company. They are categorized into three main types: operating activities, cash generated from core business operations; investing activities, cash used for buying or selling assets; and financing activities, cash raised from or used to repay debt, issue or repurchase shares, etc. Analyzing cash flows helps assess a company's ability to generate cash and manage its financial obligations. Taxes. Taxes are mandatory payments imposed by governments on individuals and businesses to fund public services and government functions. In a business context, taxes include corporate income taxes, sales taxes, payroll taxes, and property taxes. Understanding the tax implications of financial decisions is crucial for effective financial planning and management. A brief history of accounting and financial statements. Here's a brief overview of the history of accounting and financial statements. Accounting has a long history dating back thousands of years. Ancient civilizations, such as the Mesopotamians and Egyptians, used basic record-keeping methods to track economic transactions. However, the modern principles of accounting began to take shape in the late Middle Ages and Renaissance periods. Double-entry bookkeeping, late 15th century, Luca Pacioli, an Italian mathematician and Franciscan friar, is credited with formalizing the system of double-entry bookkeeping in his book, Summa de Arithmetica, Geometria, Proportioni et Proportionalita. This method revolutionized accounting by introducing the concept of debits and credits, ensuring that every transaction has equal and opposite effects on different accounts. Industrial Revolution and growth of business, 18th–19th century. The Industrial Revolution led to significant economic growth and the expansion of businesses. As companies grew larger and more complex, the need for accurate financial records became more pronounced. Accounting practices became more standardized and sophisticated during this period. Emergence of financial statements, 20th century. In the early 20th century, financial statements such as the balance sheet and income statement began to take shape. These statements provided a comprehensive view of a company's financial health and performance. The establishment of the Securities and Exchange Commission, SEC, in the United States further standardized financial reporting practices and increased transparency in the wake of the stock market crash of 1929. Globalization and international standards, late 20th century present. With the rise of globalization and multinational corporations, the need for consistent accounting standards across borders became evident. The International Financial Reporting Standards, IFRS, were developed to create a common framework for financial reporting internationally. Many countries have adopted or converged with IFRS, enhancing comparability and transparency in financial statements worldwide. Advancements in technology, 21st century. The digital age has transformed accounting practices. Computerized accounting systems, software, and electronic reporting have streamlined processes and reduced the margin for human error. Additionally, data analytics and artificial intelligence are being integrated into accounting practices to analyze large datasets and make more informed financial decisions. Financial statements and reports. Financial statements and reports are essential tools for businesses to communicate their financial performance, position, and activities to various stakeholders. These documents provide valuable insights into a company's financial health and help stakeholders make informed decisions. Here are the key types of financial statements and reports. Balance sheet. Statement of financial position. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It presents the company's assets, what it owns, liabilities, what it owes, and shareholders' equity, the residual interest in the company's assets after deducting liabilities. The balance sheet follows the accounting equation: assets equals liabilities plus shareholders' equity. Income statement, profit and loss statement. The income statement summarizes a company's revenues, expenses, and profits, or losses, over a specific period, typically a quarter or a year. It shows how much money the company earned, revenues, and how much it spent, expenses, to generate those earnings. The bottom line of the income statement is net income, profit, or net loss. Statement of cash flows. This statement details a company's cash inflows and outflows during a specific period. It categorizes cash flows into operating activities, day-to-day business operations, investing activities, buying or selling assets, and financing activities, raising capital or repaying debt. The statement of cash flows helps assess a company's ability to generate cash and manage its cash resources. Statement of changes in equity. Statement of shareholders' equity. This statement outlines the changes in a company's shareholders' equity during a specific period. It includes items such as net income, dividends, and any additional investments by shareholders. The statement of changes in equity explains how equity components have changed over time. Notes to financial statements. These notes provide additional information and explanations about the items presented in the financial statements. They include details about accounting policies, significant transactions, contingencies, and other relevant information that helps users better understand the financial statements. Management's discussion and analysis, MD&A. This section is typically included in annual reports and provides management's insights and analysis of the company's financial performance, results of operations, and future prospects. It offers context and explanations for the numbers presented in the financial statements. Auditor's report. An independent auditor's report is prepared by external auditors who assess the company's financial statements and express their opinion on whether they have been prepared in accordance with generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS.